Peace and blessings, everybody. Welcome to Sauce Factory Wednesday. Over today, we're going to be going over multiple topics today. First, we're going to be going over reversal dojis or continuation dojis. Then, we're going to go over fair value gaps and volume imbalances. And then, we're going to slide in a little extra trading stock technique. It's going to be smooth. So, without further ado, let's get to it. All right. So, oh, bad. We got a couple of little dojis here, right? Got one, two, three, four, five examples of dojis that reversed and the ones that continued, right? So here, we're gonna say if you're looking at it, right, from this bounce up, boom, boom, this one can continue, right? So the number one question is why did it continue versus reverse, even though it put the first doji in? Let's get this out the way. Even though it kind of looked janky. Okay. What we want to look at, I know if you use oscillators and some people don't. Don't you use the RSI, Melina? Yeah, you know. Where did she? Oh, she must got booted from the Zoom. Well, she had to catch the recording. All right. So I can't see the screen. Huh. What screen is showing? Can anybody else see the screen? Or yes or no? Ba-da-boom.
I
Okay.
can, but I had to change my
I
settings.
can see it. Yeah.
All right. Oh, there you go. Melina back.
Sorry, I'm gonna try to log in through my computer because phone calls be messing me up. So I apologize.
All right, no problem at all. Hey, so quick question. Do you still use the RSI right on your chart?
Yeah, I like ours. Sorry.
All right, cool. Let's get this thing out the way. All right, if you look at this reversal, right? See how price was coming up out of this little reversal point and hit, boom, and start going off. Now, this is our first doji here, right? In most cases, you may say, hey, this is going to be a failure. But by looking at the oscillators, when you're looking at the RSI, right, you see how it's going straight up right now. Then once it got over the neutral zone, which is the 50, right? That's when it got into high bullish territory. So that was a prime example to say, like, hey, let me, manage my risk and just sit and see what's going to happen. Or you can take profit, right? But still, you have to worry about a reversal coming, or they say you missed this point, you think going to continue down because of simple fact they haven't taken this level yet, right? You may say, hey, that's number to pull back because this is hindsight, but as price going on, you'll know you be like, huh, price is coming down, right? Price is bounce is coming back up. Is this a retest and it's gonna possibly push down? This is a 3-minute chart, but for content's sake, even though you see a doji, it just pulled back. It already came from the downside. Will this continue that? Will it reverse back to the downside or will it continue up? Well, we don't really know until it shows us, right? But a helping hand is looking at your oscillators to say, do we still have that momentum to say, yes, it will continue up or will it shoot straight down? And that's the whole thing, right? Is checking your oscillators. Like I used the MACD for extra confirmation, right? I had a crossover, MACD spread it apart, heading into bullish territory. So by the time this candle rolled around, right, we was at getting close to the zero level. Next candle roll over, we at the zero level crossing it, and then so forth. We're in a bullish territory now. We rocking. Now, you can also use different moving averages. So I have a 34 SMA. We right at resistance. So that's the reason why they had, a little tough time. Okay. Now let's add some other moving averages. Right here is just for everybody knowledge 921 200, right? So let's see what that's looking like. Well, we closed above the 200 on a 3-minute chart, and we right at the two moving averages converging on each other, right? So that's another sign to say, hey, we at a strong point of crossover here. Do I sit still? Now, if you happen to use a 5 EMA, nope, the wrong button, right? Let's see what that looking like. Boom. So technically you closed above the 5. So you should have been bullish, right? If you took the reversal. So you know, like, hey, we closing above the 5 EMA, which is a fast moving average, and all my oscillators are pointing upwards. Now let me see. If you haven't gotten to the trade, this is one of those moments you wait and see. You don't try to pull a trigger too fast. But if you do happen to want to pull that trigger, right, to minimize your risk management, what you'll want to do is say, my entry is the break of this low. And then my stop loss should be this high. So how it should look is a simple boom, right? If they meant to take that high out, if they're gonna go take that high, they're gonna take that high, right? Point blank. There's no reason to sit around any longer than that. There's no reason to have a stop loss way up here when this is your reversal candle, right? But the moment they didn't get you, what they did was some people probably trailed it to this moment and they simply reached down, stopped them out, boom. And also got traders who say, hey, this is a reversal because you counted on the evening star pattern because you was in a previous downtrend, not paying attention to the moving averages or where you're currently located in the trend. They'll trap you into a position and take you out, right? Same way, I want to take this from the break of that low because that is a great setup. So that right there would have been a failed, short position, but a continuation on long position. Okay. Now let's go to some positions that did play out. Right here, we had at least one down candle, then reversed back up because we was currently inside of a bullish trend. You're above a 200 with a 521 crossover. So you do have a bullish crossover, right? But price do have to retrace in certain points in the trend. So there we go. We had a push up, doji, bearish candle come straight down, right? So let's move this vertical line out the way. Boom. So that right there, let's say, hey, it is a doji and you did this for every move because you noticed the trend was kind of like overextended. Well, guess what? You would have took that. Like I told you, price shouldn't come back above this. So a price break below this, it shouldn't get above that previous pivot. So you should have been fine, right? So 14 tick stop loss. Boom, you ran it. You'll say you're trying to get one of these lows. I want the dang on low, or I want to the nearest support level, which is your moving average. So it'll be somewhere in this ballpark, right? They just happen to give you a 34 tick move on this before they continue up. So if you take that risky scalp, that's what that is. Now to say where did price go and why did it reverse? Now this goes into our other topic of the day. Fair value gaps. That's what this is, right? So we got fair value gaps and volume imbalances, right? A fair value gap is this space between here and here because price did not properly balance this candle, right? It left a gap. So when institutional investors inside of the futures market and Forex market, since price don't take a pause, price will put in a screen pushes, right? And when you have that, you have these large zones of imbalances. Price like to fill each candle by 38% to 90% of the previous candle to call it proper candle placement. It's an algorithm that the computers like to do with these candles. I don't know why, but they just does it, right? But this is what a fair value gap look like. See this point here to here. That's why I drew this little box and it'll show you like from here to here. This is the void. They target that. Boom. They come back into the zone. Then they pivot and go. Right? This they're looking for to rebalance this candle up. Notice when you look at where they stopped at, right? See how this top of this wick is here? Now look at where this wick stopped at. The finish balancing out price. This is what they like to do. Okay, so let's turn this box. Boop. There we go. So you see that? That says little zone. Because remember, price stopped way up here. When it opened up, instead of it coming down more into this candle, it stopped right here and took off. Now, what I mean by that is when I grab a fib and I'm going to measure this candle off for you. This is a little trick I do with all my fair value gaps, right? So we put a fib on it, go from wick to wick, and then you see how this candle stopped at 23%, right? So let me put the rewind on it and get rid of these unnecessary candles. Some of my great trading techniques. We don't need them. We don't need these moving averages. So from here to here, price stopped right above the 23%, left your fair value gap. Price came where? 61% of this candle, right? 61, 65%, and then it took off. I always like to target the negative 27 or the negative 61. You got a strong uptrend, you can go to the negative 61, but the negative 27 is always a great trade. So I would sometimes set limit orders in these, and I just trade it like that, right? I look and say, like, what's my negative 27 is worthwhile. Then also I go get another price action tool, say, what's my risk? It shouldn't go take this low out. So you could have said, hey, that's 10 ticks risk, 30 tick take profit, 1 to 3. I take that. Okay. So yes, that is also great. So right here, this is where your order block formed, right? So you got to understand the 2 candles down form the bearish base for the block, and then you got the explosive move up. So you follow the price action books or any of the books we have on order blocks, right? You'll see you have like 2 candles down and an uptrend like this. You had boom, green candle, then followed by 2 red candles. That's a tell to say, hey, it's forming a block here for them to push off. Now, when we talk about volume imbalances, here we go again. This is a volume imbalance, right? Well, I like to color these pink. Okay. This is how I track them. All right. So volume imbalance is when a body do not close next to another body of the candle. So you see how I got a wick, no bodies in between that. Price like to return to zones like this and rebalance that stuff out, right? They'll react to certain zones like this and bounce off of them. Then also price will come down and close in these. I like to say they are complete when they get a body close in the zone of these. That's my personal preference. That's why I noticed from my back testing. It's not in the book. You can quote me you want to. I'll let me later. But price will come down in these and they'll bounce off these zones and they'll keep returning back until they get a candle close inside of this zone to satisfy whatever needs they're looking for, right? So once we cut this off, what I'm going to do is I'm going to boom, have that stand outwards. So once we cut off the replay, we should see if something actually came back. Now, here's another example of that continuation pattern I was talking about, Melina. So you see how you got price going up, you had a doji, but it failed to go down. So what happened was you have a failure swing because this is one of your favorite patterns if it would have played out. Now, Melina, if this would have been a bearish candle, what pattern would that have been?
Evening star.
Exactly. So once you have a failure swing, the entry is the top of this candle, stop loss is here, right? That's for your trade to go off and you look for a 1 to 3. So technically you got 21 ticks for a stop loss. They give you 50 ticks for they retrace, right? But the order block is here. It's the 3rd candle in the middle. Boom. And this should be a bullish order block because price is running away from it. So let's cut this off and let's see what happened later in life. Boom, boom. Did price come back?
In between that doji, wasn't that almost like a imbalance as well, or like a kicker? Because there was no body in there.
Yes, it was. You're correct. All right, so later on, price ran through that thing. Got crazy. All right, so like I knew it. Later on, you see how price came back over here and started trading into this area of zone, but they went lower. We're gonna ask ourselves why, right? Nothing is foolproof, so we gotta ask ourselves why did they actually come in here and why did they trade lower? So what was the real target? Boom, there we go. Got a 2 candlestick rejection block right here. So when I see paired up candles like this is a heavy zone that I know for sure something is going on here, right? And 9-10, you go to the left, you'll see a whole bunch of consolidation where price was at before. So when you have the complete 180 candle, right, that comes in like this and completely wipe this trend out, that's how you know something's going to be serious. That's why when price came here, they reacted the way they did because that's a reactionary bounce, right? Boom. They went up, displaced price, pivot, then drove down lower. So this is what you do when you back test. You just simply run back, put your trend lines, look to the left, what happened, and then use these future examples to kind of like paint the story for you later on in life and your skill set. You want to be like adding to it, like, all right, this happened. Why did this happen on a higher time frame? I'm sure this is an order block because price came in his zone, played around, and popped right back out. So let's kind of I want to highlight this and I want to go up to a higher time frame, right? Oh, wrong one. I'll leave it there. I want to see like, hey, why did price react like this here? So let's simply jump up to a 12-minute real quick and bada boom. I know I ain't crazy, right? What is this? A nice fair value gap, correct? A large one.
Yep, coming off of an order block. Because that's the other thing too, is like everyone's like, oh,
Exactly.
fair value gap, fair value gap. I'm like, you can't just call it any fair value gap. It has to be like a meaningful one.
So when you have those combinations, that's what make them more deadly, right? And also, I like to see when they also displace price. So if it displays some price action, great, right? So what they did was they traded down in this, went off, okay. Later on, came back because of these two candlesticks. That's for on the block by itself. They came back down in this, went off again. But here's the thing: they can only respect these zones for so long before they blow straight through them. All right. They are not going to sit there and take that all the time and say, this is the zone for me. You're going to hold up this, that, and the third. No. Typically, your best move is when it first come back down and you take that rejection out, right? When it came back down again, it may have been a good news. What was that? 8:30. So that's right before the New York market opens. So what happened we got here is a pump and dump. So you see how they pump price up just to dump it. Because they already got the job done here, right? When they got this candle come back, they rebalanced price already. Boom, boom. But what they did was most traders who do not simply understand the fact that, hey, nothing good lasts forever, right? Just the old bait and switch. So they're gonna have you think when it come back down here again, I missed this trade. I can catch it again because they're gonna bump it up. It's very bullish, blah blah blah. Right? I can take this, but they ain't paying attention to this fact here. Your MACD said, heck no. Your RSI was in agreement, say, heck no. The moment it bounced, and you see this little check mark here on your RSI, also your MACD, you knew something was fishy, right? This is the reason why sometimes you got to stay out the market and just let things do what they do. Boom, boom, right? So at this point, it put the failure swing in and the doji held up. Why is that? Because now we're in bearish territory. The oscillators in bearish territory, all of them. So this is when you say, hey, this doji will work because my oscillators also agree with that sentiment of the reversal. So we use the oscillators not to dictate what's going on, but that's to indicate what's can potentially go on, right? When I'm taking reversals and I say, hey, this is going to continue or this should go to the dirt, I'm looking to see, do my oscillators agree with me? We got to, just like any major corporation, you got a board of directors that are going to help you with decision making, right? That's what your indicators are for. They only meant to indicate possible decisions you should make when price action do X, Y, Z. Price action at the front, indicators in the back. We read price first. We use the indicators to kind of dictate, all right, how should we go about this, right? Should we take this reversal or should we wait until the XYZ happen? Is it just a pullback or is it a continuation? What is this, right? So that's the reason why we use the indicator to say, hey, it's showing weakness here. Oh, nah, we in bearish territory. I'm gonna take this pivot point here because it's going back to the dirt. The continuation is back to the downside or the upside. In this case, we'd happen to have it to the downside. All right. Let's see if we can find the volume imbalances. So you had another little small fair value gap here. Right. It was tiny, tiny. Boom, boom. but they had an agenda. They didn't care about this one. They got a little bit of reaction. Boys took that. They took it. I ain't gonna lie to you. That's 24 minutes of straight. Then they peeled them up, not back. Now, think about these gaps on the 12-minute. We already below the zero level, right? So when you get down to the like 3-minute chart real quick, oh, we go up too far. I know prices came down here. Where is that? They acting brand new on me. There we go. Boo, 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 boo. Hello, boo boo. So when you're looking at it, you had a nice little, it hit the screen point, right? On both sides. And they said, huh. Did you overstate your welcome thinking it's going to go to the moon? That's where you sadly mistaken. Now, here we go again. We have a nice, before we zoom in, I'm going to highlight it. And this is what I'm talking about. Very nice. Very nice. I like this one. Boom. Y'all understand the color? But you know, it's a volume imbalance. Perfecto way. Okay. So you see, nobody. And the Fainsworth Key Sweat, what price did? Came back up here, right? Boom, boom. Once they got a little close right there, they were satisfied and they went on about their business back to the dessert. But that was a target. They rebalanced price. After they got done rebalancing price, they say, okay, cool. Holler at you boys later. I'm out to the dessert.
So Neo, with the imbalance, you're saying nobody on either side. But
Yes.
rebalancing with that wick is
so they coming in, right? On a 1-minute chart, this is a candle.
Mm-hmm.
Let me go. Let me put the replay on real quick so we can get rid of these other candles.
Yeah.
That's the whole thing. So when you see those wicks, we also got to understand like this is a 3-minute chart, but on a 1-minute, you already know what that is. See? Candle closes.
Mm-hmm.
Then also that's a whole nother pattern too, right here that formed. It also formed like a 1-minute order block. See what I'm saying?
Yep.
Then you had another little shuffle block right there. But you see, that's what I'm saying. Like on a higher time frames, you get zones like this, and you can trade to those or from those. But there's no like on a smaller time frame is doing all kind of stuff. So when you set your limit orders, you may say like, man, that wick almost got me because on a lower time frame, it could be something else inside of there that they're targeting. That makes sense, right?
Yep. Good.
All right, cool beans. But yeah, that's why it's best to, when you're doing this, go back during your free time, go to market replay, scroll back, highlight that zone, and then if you want to, what we can do, this is what I like to do as well when I'm back testing stuff and I want to see what's going on and I just want to get little kicks and giggles, right? I'm like, hey, this is going to happen. So the moment it hit here, this is the fair value gap. I got to train myself in this. All right. I'm going to go ahead and say, yo, I'm going to go well long on this. Boom. This is my target. I'm not greedy, right? Stop loss here. Entry to the gap. But if I put my fibs on it, it should be somewhere down here. But we're going to say it's right here just for the hell of it, right? And then when I hit play, as soon as we get there, we got to say, boom, now it's time to buy. Win. Up, they almost got us. For fairness, you got to put your stop loss down there, right? All right. Then take profit right at the lip. Boom, because you know where your zone at. So this is a way you practice, right? You just let that go and say, okay, cool, this is my risk. The trade workout. Yay, we a genius. I'm so cold. This is why I got
I have
lemon
too much
tea.
anxiety to see all that red. Ooh.
Hey, that's why the thing is this, right? You put a stop loss, so your risk is defined. That was one contract. You say that's too much red for you. Well, we can drop down to micros, right? We can make this work whatever way we want to make it work. So you can go to micro and say, well, 10 contracts, 1 mini, 5 contracts, half of a mini, that's 250 tick, right? So I can minimize my risk like that. You feel me?
I
So
feel
those
you.
do. So you don't have to live and die by this amount here. Yeah, that's the thing. So it's multiple things to do about that, right? That's the great thing about the micro contracts and the mini contracts. We don't have to do full risk. It's so many ways to flip this. Let's add more micros. Then you can say, well, if I do more micros, I can scale out here. I can scale out here, blah, blah, blah. And I can scale out here, right? Just like that. So let's run it back. We're gonna run it back again. Let's say this time we had more micros, right? So we're gonna change this number. We're gonna do 3 scale outs, right? So we need 3 contracts. Then we're gonna hit play. Then let them boys go. They do come on down. Come on down. Boom. We in now, right? So now I'm gonna change this back to 1, right? And then we're gonna wait. Boom, boom, boom. Take profit. I want to get out right there because I'm not greedy. When pigs get fat, hogs get slaughtered. All right. Boom. 1 contract gone. Okay, great. Boom. 2nd contract gone. Now I'm sitting here, right? So I already booked 410 profit. Let that to marinate. Boom. 3rd contract off. So did we get the whole entire 1400? No. But what we did lock in was 965, low risk. We didn't have to worry too much because once this first one went off, that paid for the whole entire trade. Now from there, the second one off, okay, cool. Now we made our profits. 3rd one, we booked more profits. That's our continuation. So that's the mindset you got to have behind that when you doing multiple contracts. And that's the power of you trading micros or there's multiple contracts in general. You can just, hey, sell this one, boom, sell this one, sell this one, sell this one. You feel me? And you can kind of scale out and keep your risk to a low, or you're gonna set limit orders in those directions. As price get up there, they'll naturally take you out, naturally take you out there, naturally take you out there. And you can kind of be, a little more relaxed. It's some people, they do full positions where they'll kind of like scale into a trade at certain key levels, but that's kind of like you getting the best price. Those work fine. If you're getting like a fair price, that's a difference. So let's run it back, right? Let's go. Let's do it again. This time we're gonna buy 2 contracts as price go on like that and see like what's the difference. Okay, we got our 1. Okay, let them do it. We ain't buying in the red. We don't buy in the red. You don't average down, you average up. Right? Averaging down, get you in a problem. Boom, green now. Let's buy another contract. Okay, great. Let that ride. It's still red. Cool. We're gonna buy another contract on that pullback. Okay, great. Now we're gonna wait till we get our block. Uh-oh. They slipping. Get up there. Get up there. All right, we sold. We flat. Boom. We out. We made $900, right? See the difference? We lost
That's so
$60.
funny. It was the same. It was the same $900 from the previous one.
Well, technically, we made more the first time because we scaled out versus because remember our order was here, right?
Yeah.
265 was our initial entry. Now, when we bought over here, we didn't really we was close to the same price. And then we got over here, we was close to this price here, close to the entry, but we still was buying above our entry. So that also took our average up. You get what I'm saying?
Yeah.
Those work great when you got a large range to trade in, and let's say we was going a little bit higher than this. That would have been fine, us buying at this level to make sure that we have a good uptrend and we safe to go, right? But in most cases, you got a tight range. You shouldn't do that with 100 ticks available to you. because you don't get that right buy-in, because who gonna buy in a red? You don't want to really average into a loser, right? If it's gonna lose, I'd rather lose one contract versus buying into adding two contracts and doubling up or tripling up my loss. So either we lose all at once, or I wait till it shows more promising to then average into it like that. That's another key. Most people average in while it's doing all of this and they hoping it does that. Well, let's say it don't do that, right? Let me see. Where did the trade go hella wrong against us?
I was thinking you would get in where it made a slightly higher low. I would think you'd be like, okay, hey, it's not going back there. That right there. If you did a fib from the bottom to the top of that evening star, that little evening star, I feel like that's a 618. I don't know for sure, but I think that's what it is.
So you talking about here?
No, go down to the bottom. Go down to that little wick right there. Not that, there. No, yeah, no. Go to the left. Yeah, that candle right there. I think that retraced to 618. I think it's a 618 retracement.
So let's go. So we'll
That
go
one, yeah.
go
That
there.
you got it.
So it did when it finally came down. I actually did a 78, but yeah, you was up right here. Yeah, you was right there. Right here, it's your 618. Then they did a 78, which is still smooth. So
I like 78. Yeah, okay.
That definitely is a great retracement. So you wanted to, you could have, but at the same time, right? We entered here, so we deep in the red. So you got to say like, hey, is this part of my trading plan to average into a red trade, or to wait till it goes back green to show a little more promise for me to average in? Which one's safer, right? Because it could have failed here and then took us out, because that happens, right? I've been in those opportunities, those setups before. And if you read the books, they always say, hey, you don't average into losers. You wanted to make sure it's winning, and then you average up into that, or you just put on your full position and average out. Some people do average down into red trades. Sometimes it works, sometimes it don't. But this is a replay, so we can easily say that now. But as we trading this, do we want to say that, or do we want to try to catch this on the way out? Now I can see us coming on the way out of here, right? As they hit the 71, they start passing up price and they starting to, yeah, that's a safe bet to say like, okay, they're getting that forward movement, and I just move my stop loss up to this is my new stop loss, right? So if anything, you can readjust your stop loss to this pivot point and say, hey, if they come back for this, yeah, get me out of here, right? With the swiftness. Then you can say, I'm not going to be that bad off. And that would be at least some better risk management versus keeping the same stop loss down here and then adding a contract and letting it come way back and stop you out. That makes sense?
Yeah, no, that makes sense, because I look at that candle as it opened in the 618, but it didn't close in the 618. So because I don't have a body closure in the 618, I'm still golden, because it's just, because I always look at wicks of tricks. So it's like I still would have been good, because if I have a body close below 618, then I'm out. Then I'm cutting the trade. I'm like, forget it. I'm not even waiting for the full stop loss.
Yeah.
But that's just me. That's my rule.
Okay. Yeah. I got you. Well, hey, if it works, don't break it. That's how I say it. Don't break it.
Because guess what? That's really a morning star, and a morning star always has to retest the 618. Yeah, that's okay. Yeah. Okay. All right. No, I see you. Neo.
Yeah. Smooth. All right. So we do these little things, and just totally up to you. Back test them, see what works. I want to do this. I like to back test with a winning strategy, also a failing strategy, because I want to know how bad will I lose if this go terribly wrong, right? I love doing that. So let's say we were here, right? Let's pull it back. Boom. Because we crazy. We say, hey, this is our reversal. Because remember, they was here before, right? So they say, hey, they're going to be the reversal point. Boom. You're going to say, we're going to go long. We went long. Okay, great. All right, we got snap. They're going. We're gonna buy again because we're gonna average down because we crazy like that. All right, bet we up. We up again. Oh snap, we red. What we gonna do? Oh snap, we down $400. Oh, what we gonna do? We gotta get the hell out. That's $800 loss, right? That's you don't have a stop loss. You know that shit is being reckless. But that's what can terribly go wrong. You're down 800, right? Now let's run it back. Let's see if we would have stuck with our original loss. Same exit. Before we do that, let me mark that exit, right? 266.61. All right. So we're gonna mark that exit. Stop loss. Okay. Then we're gonna go replay. Boom. Let's play. No, that ain't the candle. That's the candle. Boom. We go long. Stop loss. There. All right. Okay, cool. This one we was dumb enough to average in. What's happened? Oh, okay, cool. We only lost $350. So we lost
Why are you
350
going
first.
I don't get
Because
that. I don't get
this is us going against the trend. Let's say we took this fake reversal, right? Because we thought this was gonna be it. Like I told you, we gotta practice both sides of the coin to understand what's real.
Got it.
So
Got it.
you practice to win, but you also got to practice what failure look like. If you understand what you can possibly do wrong and what you shouldn't do, then you know, like, okay, I shouldn't do that dumb crap live. And this is the reason why we don't average down in the losers, right? So when things went bad, we went with them, right? So this is all right, cool. We took the trade in the middle of a downtrend, right? We say, oh, that's the pop. But what they did was they did this. This when things went bad, right? And then this one we went with them because we said, hey, we're gonna average down because we smarter than the market. And then this is when they showed us we dump. Okay. See how that works? Now, this reason why you don't average into losers because it showed us a little bit of green because whoever get out when they save, right? We always say, hey, if you save me this time, I promise I won't eat that food again. I promise I won't drink this much again. I promise if you just help me out this one time, I won't do this again, right? And we've been there. Trade goes green. We say, son, I'm green again. I shouldn't exit. I should keep holding because now it's going to go in my direction and magically save me, right? But this is the lie that the devil told you and you fell for it, right? He took it back your direction. Let's give you a little bit of praise. See, this is God doing. And this is when your ego kicked in and said, I know better. Instead of you getting out like you promised, you went for a ride. Okay? That's what I showed there. That's the reason why we back test this. You got to play both sides of the coins because we ain't always smart. Our ego getting away most of the time we trading, right? We get trapped. I done it myself. I'm like, man, it's finally turning around. I'm going to go ahead and hold on, see how far it's going to take me. It's going to go to my take profit now. I was just early. And I get the saying all this dumb crap to trick myself into believing I'm smarter than the market, right? And then after I get done to convincing myself, selling me this wolf ticket that I bought, that I created, and I'm like, I'm supposed to sell this stuff, not buy it, and surely not use it, right? Guess what? This is the results of it. So this is us being honest with ourselves. How many times do we take positions like this in a rushing downtrend, say, no, this is the reversal point. I know I'm right. I'm about to take this reversal to the moon, it'll just a pullback. And then they take your wig right out your head. They swoop. You out here looking, you bald, man. You looking wigless. It snatch your wig, got you out here looking all kind of crazy. So, yeah, this is a prime example. So we take that L with good graces, go on about our business. Okay? Now, those volume imbalances and fair value gaps and also continuation moves. So like here, right? So remember, here's another fake reversal, right? So remember how it's somewhat reversed, but if we look at oscillators, there was in bearish territory. So this doji did a pullback. All it did was set up for a pullback and then it dropped. This doji here, right, set you up for a nice continuation move. So you had a doji, even though it's kind of like great, dropping at the bottom of it, it still showed you like, hey, this was an indecisive candle. But what they did, they finished it off with this bearish candle, right? This strong bearish candle. They say, nah, we good. Pull back, then dump. Why? Because your oscillator's in bearish territory the whole entire time. That should tell you it wasn't ready. If it was ready, you would have had some form of support on your oscillators. It's curling, right? So since we're on a 1 minute, we're going to show this reversal. Let's watch the oscillators and how they move. You see how they starting to curl up. They're coming out the oversold zones, the over demand zones, right? And they starting to say, hey, we are starting to pop. And there you go. You got a crossover on a MACD. Boom. You got your crossover. Your oscillator starting to come up. They building a base. Boom. Boom. Okay. Say building a base here. And he's starting to get some ground up, right? But that's what you're looking for. Price come down. If it come back retest, you want to make sure it's not closing below. And you want to make sure if it's going to test the low or come higher. But you don't want it to break the low. And that's give you your confirmation the moment it pivots above this area here and say, hey, we good. We on our way out, right? But you see your oscillators starting to separate. They getting up to the neutral zone and they starting to cross into bull territory and do what they do best.
Yep, and that's like a little mini W. Yep.
And then you had price coming to another little fair value gap on a 1 minute. See all these things play out. They play out, right? Well, let's get that little box out of there. Right. So boom, they came back to this fair value gap. So the people who did not get this entry because they are scary, right? They say, nah, I'm gonna take this entry here. Boom. And why did they want this gap versus this gap? Because technically you had one here, right? But we'll say like why they want this one. Why what's the hot topic? Why this one getting out of the play and the other one's not, right? Well, we got this thing called displacement. Look at these oscillators out here, right? I don't need no indicator origin. Boom. This candle displaced price, not this one. This one's still trapped in price. This one displaced price. So you'll say like, what's the possible hole up here, right? They don't want that one because this one actually displaced price. So this is the one that's more of a hot topic here. This one didn't do nothing. It got up there. It looked good, but it didn't do much. It wasn't effective. This one was effective. That's the reason why they came holler at this bad boy and went on about their business. You feel me? This one did not do nothing. Same with this one. It came, took care of this. That one came one more up. Okay, cool. But they dropped down into this zone here because you had this point of consolidation, price like consolidation points. They'll come up out of there, right? But they didn't come back down to this low because this one didn't displace price. This candle did. Okay. We'll call this a DP. You got DP'd. That means. Displaced price. Okay. So this one displaced price. So this one's this one's a go. Bing bing. Let's see. I got yeah, there we go. Check. And then we got a X. Okay, so you're looking for setups like this. Displace a price, not displace a price. So we don't want to get greedy and say you're going to come this low and have our limit orders way down there. We're going to be taking caution up here. If you do have to second guess that you have multiple order blocks or multiple fair value gaps, right? They simply say, hey, I'm going to wait and see what price does when it get here. I want to see a reaction. Once I see my said reaction, then I will take my said trade. If I don't see a reaction, I won't take the trade, right? So when price coming back down into the zone, I want to see price leaving out of the zone with some speed about itself, right? I want to see it have some urgency about itself leaving out of here. And on the way out, I will take my order. Nice little trick I like to do is I want to set a limit order right above it, right? I'm going to say, hey, this is a good spot. I'm going to have my order sitting like somewhere like right here. So when price start coming back out, they'll hit my order, trigger it, boom, and I already know what time it is, right? And how it'll look, something like that. Like, come here. Get over here. Boom. So I was like, all right, this is my low. That's the pivot point, and I'm aiming for the highs, right? So that's how my order should look. I want to be like right above it. So as price going down, and when price start retracing, they should hit my limit order. We in the trade, we cracking. The wick should be your stop loss. You shouldn't have to risk that much because that's your pivot, and that should tell you like, hey, if it do break that level, that means it's gonna go lower. I'm wrong. Let me get the hell out of Dodge. What's the least amount of risk I can take? That's the best thing for you. All right, peace and blessings. Ooh, yeah, post your chart later. Get at me. Okay, let's go.
Thank you.
No worries, no worries. Okay, no worries. Now, that's for the technical part. Right. So with that flush, we're gonna do that off the recording.
Okay.
So yeah. So we're gonna go ahead and stop the recording here. Let's let me say do this.